On October 19, 1987, $500 billion vanished from the U.S. stock market in a single day. That's $500 billion, gone in just 6.5 hours of trading. The Dow Jones dropped 22.6%, the largest single-day percentage decline in stock market history. To put that in perspective, during the infamous 1929 crash that triggered the Great Depression, the market only fell 12.8% on its worst day. But here's what makes Black Monday truly terrifying. To this day, nobody can definitively explain why it happened. There was no war declaration, no major bank failure, no political crisis. The economy was actually doing pretty well. Yet markets around the world collapsed like dominoes. Hong Kong fell 45%, Australia dropped 41%, and the UK lost 26%. What you're about to learn is how a perfect storm of new technology, human psychology, and financial innovation created a monster that nearly destroyed the global economy. And the most unsettling part? The same conditions that caused Black Monday exist in our markets today, only now they're 1,000 times more powerful. If you want to understand the economic stories that shaped our world while most people were sleeping through them, hit that like button and subscribe to the Sleeping Economist channel. Ring the notification bell, because we're uncovering the financial mysteries that textbooks don't teach you. Chapter 1. The Golden Age Before the Storm. In 1987, America was riding high. Ronald Reagan was president. Wall Street, the movie, was glamorizing stock trading, and everyone wanted to be Gordon Gekko. The stock market had been on an incredible 5-year bull run. The Dow Jones had tripled since 1982, climbing from 776 points to over 2,700 by August 1987. But beneath this prosperity, 3 revolutionary changes were transforming Wall Street. First, something called portfolio insurance had become the hot new trend. Think of portfolio insurance like an automatic airbag for your investments. Computer programs that would automatically sell stocks when prices started falling, supposedly limiting your losses. By 1987, over $100 billion, about 3% of the entire stock market, was protected by these programs. The second change was index arbitrage. This is where traders use computers to spot tiny price differences between stock index futures in Chicago and actual stocks in New York, making instant profits by trading between the two markets. It's like finding that a candy bar costs $1 at one store and $2 next door, then buying low and selling high, except computers were doing this thousands of times per second. The third transformation was the birth of program trading. Computers programmed to automatically buy or sell millions of dollars in stocks based on mathematical models. By 1987, program trading accounted for 15% of all daily volume on the New York Stock Exchange. Wall Street had essentially handed over the steering wheel to machines. Now, each of these innovations seemed brilliant in isolation. Portfolio insurance protected investors, index arbitrage made markets more efficient, and program trading removed human emotion from investing. But nobody had asked a crucial question. What happens when all these computer programs try to sell at the exact same time? The warning signs started appearing in early October. The market had peaked at 2,722 points on August 25th, then began a gradual decline. Interest rates were rising. The 30-year Treasury bond yield had jumped from 7.5% to over 10% in just 6 months. This made bonds more attractive than stocks, and smart money was starting to leave the market. Chapter 2. The Countdown to Catastrophe. The week before Black Monday was when things started getting weird. On Wednesday, October 14th, the market dropped 95 points, the biggest one-day point drop ever at that time. Thursday saw another 58-point decline. Then came Friday, October 16th, which traders would later call the day the market went insane. That Friday, the Dow plunged 108 points, losing 4.6% of its value. Volume exploded to 338 million shares, smashing all previous records. But here's the truly ominous part. In the final hour of trading, portfolio insurance programs kicked in and dumped $500 million worth of stocks onto the market. It was like watching a preview of the disaster to come. Over that weekend, something unprecedented happened. Usually, Wall Street professionals spend weekends on their yachts or golf courses. But this weekend, they were glued to their phones and computers watching Asian markets open Sunday night. What they saw sent chills down their spines. Markets were collapsing across the Pacific. Meanwhile, a perfect storm was brewing. The U.S. had just attacked Iranian oil platforms in the Persian Gulf, raising fears of military escalation. Treasury Secretary James Baker had threatened Germany with a dollar devaluation, spooking currency markets, and proposed tax legislation threatened to eliminate deductions for corporate takeovers, which had been driving much of the bull market. But the real problem was mathematical. Those portfolio insurance programs were all using the same basic formula, created by academics named Fisher Black and Myron Scholes. The formula assumed that markets moved smoothly and gradually, like a river flowing downhill. But markets don't always flow. Sometimes they drop like waterfalls. And when prices gap down dramatically, the formula breaks. By Sunday night, October 18th, portfolio insurers calculated they needed to sell $12 billion worth of stocks on Monday morning. That's 20% of an average day's entire volume, all selling at once. The head of the New York Stock Exchange, John Phelan, would later say he went to bed that night knowing Monday was going to be the worst day of my life. Chapter 3. The Day the Sky Fell. Monday, October 19, 1987, started with an eerie calm. The opening bell rang at 9:30 a.m., but for several minutes, many stocks didn't trade at all. There were simply no buyers. When prices finally appeared, they were devastating. Coca-Cola opened down 10%. IBM gapped down 11%. Some stocks didn't trade for over an hour. Within the first 30 minutes, the Dow had plummeted 200 points. Portfolio insurance programs immediately triggered, dumping billions in sell orders onto an already overwhelmed market. It was like everyone rushing for the same exit door during a fire. The very act of trying to escape made the situation worse. By 10:30 a.m., the Chicago Mercantile Exchange, where stock index futures traded, had fallen so far below New York prices that index arbitrage programs went haywire. These programs started selling massive amounts of stocks in New York to buy cheaper futures in Chicago. But the selling pressure in New York drove prices down further, which triggered more portfolio insurance selling, which caused more arbitrage selling. It was a death spiral. At noon, rumors started flying that the Chicago Mercantile Exchange was about to close. This caused pure panic. If Chicago closed, portfolio insurers couldn't hedge their positions. They started selling everything they could, as fast as they could. The specialist firms on the NYSE floor, the dealers responsible for maintaining orderly markets, were overwhelmed. One specialist later said, "It was like trying to stop a tidal wave with a teaspoon." By 1 p.m., the Federal Reserve realized the entire financial system was at risk. Banks had lent billions to Wall Street firms, and if those firms collapsed, the banks would too. Fed Chairman Alan Greenspan was on a plane to Dallas, completely cut off from communication. His deputy, Gerald Corrigan, had to make one of the most important decisions in financial history. The carnage accelerated into the afternoon. The Dow was down 300 points, then 400, then 500. Trading systems broke down completely. Orders that normally took seconds to execute were taking 45 minutes. Investors had no idea if their trades had gone through or at what price. It was chaos. Chapter 4. The Meltdown and the Miracle. As Black Monday progressed, the crisis spread like a virus through the financial system. Major corporations couldn't roll over their commercial paper, the short-term loans they needed to make payroll and pay suppliers. If this continued, household names like General Motors and IBM might not be able to pay their employees by Friday. The options market completely froze. Market makers, the firms that guarantee trading can always happen, simply stopped answering their phones. One trader described walking onto the trading floor and seeing grown men crying. Another said it looked like the end of capitalism. By 2 p.m., several major Wall Street firms were technically insolvent. They had promised to buy stocks from clients but didn't have the money to pay for them. E.F. Hutton, one of America's oldest investment banks, was within hours of collapse. Kidder Peabody was rumored to be bankrupt. Then something remarkable happened. At 2:30 p.m., the major market index futures contract in Chicago staged a mysterious rally. Nobody knew who was buying, but someone with very deep pockets was stepping in. Prices rose just enough to stop the most aggressive portfolio insurance selling. Years later, it was revealed that the Chicago Fed had quietly encouraged major banks to support the market. When the closing bell finally rang at 4 p.m., the damage was catastrophic. The Dow had fallen 508 points to close at 1,738, a 22.6% decline. Volume hit an unbelievable 604 million shares, nearly double the previous record. Market value lost $500 billion. To put that in perspective, the entire U.S. federal budget in 1987 was about $1 trillion. But the real crisis was just beginning. That evening, as Wall Street executives tallied their losses, they discovered something terrifying. Many firms didn't have enough capital to open for business Tuesday morning. The clearinghouse that settled all trades was short $1.5 billion. If it couldn't open, the entire market would freeze. Chapter 5. The morning after. Tuesday, October 20th, started with the very real possibility that the U.S. financial system would collapse before lunch. Several major investment banks were hours from bankruptcy. The Chicago Mercantile Exchange was considering shutting down futures trading, which would trigger more panic selling in stocks. At 8:41 a.m., before markets opened, Alan Greenspan made a one-sentence announcement that saved capitalism. The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. Translation: we'll print as much money as necessary to keep the system alive. The Fed immediately flooded the system with cash, lowering interest rates and lending billions to banks. They made it clear that any bank that didn't lend to Wall Street would face their wrath. One Fed official called bank CEOs personally, saying, "You will lend to your Wall Street clients, or you will find the Fed to be a very unpleasant regulator." Miraculously, it worked. Markets opened Tuesday and actually rose 102 points, then 186 points on Wednesday. The immediate crisis had passed, but the long-term consequences were just beginning to unfold. The crash triggered the first major overhaul of market structure since the 1930s. Circuit breakers were installed, automatic trading halts when markets fall too fast. The SEC gained new powers to investigate program trading. The Brady Commission spent 2 months investigating and concluded that financial markets had become one market, linked by technology in ways nobody fully understood. Portfolio insurance, the product that was supposed to protect investors, essentially disappeared overnight. Investors learned that you can't protect against market crashes by selling into them. That just makes them worse. The Black-Scholes formula, which would win a Nobel Prize in 1997, was revealed to have a fatal flaw. It assumed markets behaved rationally. Black Monday proved they don't. But perhaps the most important change was psychological. Black Monday introduced the Greenspan put, the belief that the Federal Reserve would always step in to save falling markets. This created what economists call moral hazard. If you believe you'll be rescued, you take bigger risks. This mentality would contribute directly to the dot-com bubble, the 2008 financial crisis, and arguably every market bubble since. Chapter 6. The Ghost in the Machine. So what can regular people learn from Black Monday? First, understand that the stock market is not the economy. In 1987, despite the crash, the economy kept growing. GDP rose 3.4% that year. Unemployment kept falling. Corporate profits stayed strong. If you had held your stocks instead of selling in panic, you would have recovered all your losses within 2 years. By 1989, the market had hit new all-time highs. The investors who got destroyed weren't the ones who held. They were the ones who sold at the bottom. This brings us to a crucial lesson about market crashes. They're temporary, but the decisions you make during them are permanent. Sam Walton, founder of Walmart, lost $1.7 billion on Black Monday, more than any other individual in history. His response? He shrugged and said, "It's only paper." He didn't sell a single share. 5 years later, those shares were worth 3 times what they were before the crash. Second, beware of portfolio insurance in all its forms. Today, we have stop-loss orders, risk parity funds, target date funds, and algorithmic trading systems that promise to protect you from losses. But when everyone uses the same protection strategy, that strategy becomes the danger. It's like everyone in a crowded theater agreeing to walk calmly to the exit if there's a fire. It works great in theory, but panic is contagious. Think about stop-loss orders, which automatically sell your stocks if they drop to a certain price. Sounds smart, right? But what happens when millions of investors set stop losses at the same levels? Say, 10% below current prices. When the market drops 10%, all those orders trigger at once, causing a further drop, which triggers more stop losses. You've created a cascade of selling that has nothing to do with actual company values. Third, recognize that we've made the Black Monday problem worse, not better. In 1987, program trading was 15% of volume. Today, algorithmic and high-frequency trading account for 70% of all stock market activity. These programs can execute millions of trades in the time it takes you to blink. We haven't eliminated the risk of computer-driven crashes. We've amplified it. Consider the flash crash of May 6, 2010, when the market dropped 1,000 points in 36 minutes, then recovered most of it. Some stocks traded for a penny. Others traded for $100,000. It was Black Monday compressed into half an hour. The cause? A single mutual fund selling program interacted badly with high-frequency trading algorithms. If 1987 was a car crash, 2010 was a 100-car pileup at superhighway speeds. Fourth, understand that complexity is not your friend. The portfolio insurance that failed in 1987 was based on Nobel Prize-winning mathematics. The mortgage securities that caused the 2008 crisis were rated AAA by the smartest analysts on Wall Street. When someone tells you an investment strategy is too complicated to explain simply, remember Black Monday. The firms that survived best were the ones using the simplest strategies. Buy good companies. Hold them. Don't use excessive leverage. The warning signs to watch for today are remarkably similar to 1987. Rapidly rising interest rates. Check. The Fed raised rates 11 times between 2022 and 2024. Excessive speculation. Check. Look at meme stocks, cryptocurrency, and SPACs. Everyone using the same strategies. Check. Passive index funds now control over 50% of the stock market. And most importantly, complacency. When everyone believes the market can only go up, when complex financial products promise risk-free returns, when computers make more trading decisions than humans, that's when you should be concerned. But here's what's really different today: the speed of information. In 1987, most investors learned about the crash from the evening news. Today, you can watch your portfolio evaporate in real time on your phone. This instant information can be a curse. It makes panic selling easier than ever. The average holding period for stocks in 1987 was 2 years. Today, it's less than 6 months. We've become a market of traders, not investors. There's another critical difference: the role of central banks. Black Monday taught governments that they could prevent financial collapse by flooding the system with money. They've used this tool repeatedly: in 1998 during the long-term capital management crisis, in 2001 after the dot-com crash, in 2008 during the financial crisis, and in 2020 during COVID. Each intervention has been bigger than the last. The question isn't whether this strategy works, it's what happens when it stops working. The most practical lessons for individual investors are simple but hard to follow. First, diversification still matters. Investors who held bonds alongside stocks in 1987 lost much less. Second, don't invest money you'll need in the next 5 years in stocks. Market crashes always happen when you least expect them. Third, have a plan before the crisis hits. Decide now what you'll do if your portfolio drops 20%, because you won't think clearly when it's happening. Finally, remember that Black Monday remains the financial world's greatest mystery. We know what happened, but we still debate why. Was it computers? Psychology? Random chance? The answer is probably all three, combined in a way we didn't anticipate and still don't fully understand. Brady Commission interviewed hundreds of participants and reviewed millions of trades, but their 350-page report essentially concluded a lot of things went wrong at once. If stories like this, where we uncover the economic events that shaped our world while most people weren't paying attention, fascinate you, please like this video and subscribe to the channel, because we're just getting started with these financial educational mysteries.